Great. So I'm going to talk to you about this report, Premiums Under Pressure. We decided to look at this topic this year because, as you will have been very much aware, there's been a lot of, well, increasing number of climate change related events or events that have been intensified by climate change around the world. Last year in New Zealand, we obviously had those two really big flooding events with the Auckland Anniversary Day floods and the Cyclone Gabrielle as well. So we've really been actually noticing in our day-to-day lives how climate change is starting to affect us all. Meanwhile, prices for our insurance have been going up. Some people have been having to drop their insurance because of the increasing cost already. And so it seemed like a really great time to get into this issue, which I think has not been having a huge amount of attention from the policy side, especially recently. So I thought it was a good chance to really bring up some of these issues and see where we're headed in terms of premium prices for residential insurance. So many houses are already vulnerable to flooding. About nearly 15% of houses are already vulnerable to flooding in New Zealand, some flooding, and about 5% of houses are vulnerable to what they call extreme levels of flooding, which means basically a 1 in 20 year return period for flood risk. A lot of people are vulnerable to more than one type of flood risk. River flooding is the type of flooding that impacts the most number of homes, but coastal inundation, and especially the increase in coastal inundation caused by sea level rise is the hazard that's going to be increasing most quickly and having the biggest impact on our premium prices in the near future. So the greatest number of houses exposed to river flooding are in places like Auckland, Christchurch, Lower Hutt, Napier, Palmerston North. And then the places where the biggest percentage, I guess, of houses exposed are in places like Buller District, Thames, Coromandel, Wairoa, Central Otago and Gore. So those are the places that would have probably the biggest impact on their communities due to river flooding. Sea level rise is the one that's having the biggest impact on our premiums, or will do in the near future. Just a very small amount of sea level rise is going to have a huge impact on the return period for major coastal flood events. So regions with major coastal urban areas that are likely to be seriously impacted by sea level rise by 2050 include places like Bay of Plenty, Hawke's Bay, Wellington, Canterbury and Otago. Right, so where are we with insurance premiums right now? We are finding prices are already high and rising. They've been going up around the country, but especially in places that have both flood and seismic risks, places like Wellington and the Hutt Valley and Christchurch, for example. So you can see the black line here is the dwelling is the cost of residential insurance, and the blue line is the construction cost index. So insurance premiums have been going up faster than both the consumer price index and the construction costs. So there are a range of different reasons for price increases in premiums over the last few years. One of them is that obviously inflation has happened and made construction incredibly expensive for insurance companies, so they've had to reflect that in their prices. But also reinsurance prices have gone up. So reinsurance is, for those who don't know, insurance for insurance companies. So insurance companies go to the global markets and get reinsurance for some of their biggest risks. So if we have a major disaster here, insurance companies will go to reinsurance, to their reinsurance to cover some of those costs. So reinsurance companies have been having a bit of a think about global weather events and have been reflecting increasingly large weather events in their premium prices. So events like floods in Northern Europe and Spain, and the hurricanes in Florida. That's all sort of filtered down to us a little bit in terms of our premium prices as well. Similarly, those big weather events we had at the beginning of last year in the North Island, I think have been a wake-up call to reinsurance companies about the risk in New Zealand of weather events. Up till now, they've been mostly focused on the risk of earthquake events for New Zealand, but now they're seeing that actually weather events are also a major thing in New Zealand. So all of that's having an impact on our prices, as are increasing government levies for fire and earthquake cover recently. And then finally, something else that's been pushing up insurance prices is a move to risk-based pricing for flood risk. So this means that rather than the flood risks being shared collectively, they're being put onto the people that actually have the risk. So this is due to improvements in data and technology. So insurance companies are able to say, oh, actually this house has got twice the risk of this house, so we're going to charge them twice as much in terms of flood risk premiums. We've always had risk-based pricing to some extent for earthquakes in New Zealand. So if you're in Wellington, you'll be paying a lot more than if you're in Auckland for earthquake risk. But that's been flattened to some extent by the fact that we have the NHC, Natural Hazards Commission, used to be called the Earthquake Commission. So we have flat, what they call community-based pricing for earthquake hazard under the NHC, which flattens some of the risk-based pricing that we would otherwise be seeing for earthquake risk in New Zealand. Flood risks are mostly covered by private insurance in New Zealand, and up till now they've been mostly community-based pricing, which means we collectively share the risk. But some insurance companies are now starting to move towards risk-based pricing. So that means for those houses that are at some flood risk, their premiums will be going up very quickly and very steeply. And this has sort of already started to happen. So rising prices, as I said, prices have already started going up a bit, and we've noticed that some people are already starting to drop their insurance cover because of those prices. Over time, we're expecting many more will do so, or they'll insure themselves for less. So they might put up their excess, or they might insure themselves for a lower amount, which means they're not then fully covered in a disaster. And that's known as partial retreat. And partial retreat can be led by the customer who decides they want to try and save money, or it can be led by the insurance company that might decide they don't want to fully insure a particular property because it's not economically viable for them to do so. Another thing that we're likely to see in the future is this idea of unbundling of hazards. Sounds like a Christmas present, but it's not quite as good as that. So in New Zealand, we've got, traditionally we've had bundled insurance policies, so all perils policies. So when you buy a policy, you get covered for fire and flood and earthquake and other things. So in other countries, they do it differently. They might sell you your flood policy separate from your fire policy, for example. Florida is a really good example of that. So if you can get flood insurance there at all, it's sold separately and it's very expensive. So in practice, that means that many people don't actually buy flood cover, they just buy fire cover. And that's obviously a problem because the biggest risk for your property is the part that's going to cost the most. And so it's also the part people may not then get cover for. Yeah, so that could lead to problems in the future if we find people becoming underinsured against their most pressing risks. And then finally, insurance retreat. Over time, probably within the next decade or two, we're expecting to see insurance companies beginning to withdraw insurance cover from some areas entirely, especially in response to sea level rise, as I mentioned before. So that's known as insurance retreat. It's really become a problem overseas in some places. Florida springs to mind, but then another example is California, where you can't get fire cover in some places, wildfire cover. At some point for insurance companies, economically, it no longer will make sense to insure some properties. And we see, for example, in the United States, cover is going down steadily, partly for that reason. Now, high insurance cover is really important for a number of reasons. Firstly, it makes us more resilient as individuals, as communities, as a country. Christchurch earthquakes are a really good example of this. Back in 2010, 2011, they were actually the most heavily insured earthquake events in history, interestingly enough. I was really surprised to learn. And they were the fourth most expensive insurance event ever at that time. And although it didn't feel pleasant for many people who were involved in those events in terms of getting money back and rebuilding, it was actually a really good example of resilience, because we were able to rebuild as a country very well due to our really high levels of insurance. Something like close to 80% of all the economic losses were covered by insurance, which was a huge amount. Other reasons insurance is really important: house values. It's in everyone's interest to have high cover because it protects all of us. If you think about the fact that to get a mortgage, you need to have insurance. You need to show you've got an insurer willing to cover your property. The problem will really arise if insurers start to withdraw from some houses. Those houses will no longer be able to get a mortgage against them. So the market will go out of the bottom will go out of the market for those houses potentially almost overnight. People will struggle to sell their properties. They'll be worth next to nothing. That could have huge, social and economic impacts on people. Equity is a major issue as well. If we can no longer, if some people or some whole communities perhaps can no longer afford cover, that's really going to increase inequalities that already exist and entrench poverty for some, which is concerning. Oh, yes, I just put this little graph here to show. This is from Belinda Story et al. And she did this wonderful little drawing that can help show us how in the 4 major cities, in areas that currently have a 1 in 100 year flood risk, return risk, within the next 10 to 15 years, we're going to see partial retreat. And within the next 20 to 25, we might see full insurance retreat for around 10,000 properties. And that's just in these major cities and just for coastal erosion and inundation at the coast. So it's a big issue. It's not a distant issue. It's on the horizon, coming up pretty fast kind of an issue, and we need to start thinking about how we deal with it. Check the time. Right, I've got to hurry myself along. So Aotearoa's insurance market is characterised by reasonably high uptake. We've got about between 84 and 95% of homes covered here, although it's actually quite hard to see based on the data how high it actually is, because that data is mostly kept by private insurance companies and not released publicly. We're quite high on international standards, but not as high as other countries, say France and the UK, for example, that have public flood insurance schemes in place. We've got we've got high market concentration, which means not that many companies over here. I think the top 4 companies own about or generate around 88% of private residential market. I talked about all perils policies before. That's a characteristic of the New Zealand market. And annual contracts, which means, and that's normal internationally to have annual contracts, but it does mean that the picture of the market can change pretty quickly within a short period of time. Another characteristic is we have the NHC, formerly EQC. It's a scheme that's greatly admired overseas. It's a scheme that's really seen us through some tough times in a really good way, and so it's pointed to by lots of people overseas and by reinsurers as well as a thing that makes them see the New Zealand market as somewhere worth investing, because it kind of gives a buffer, a risk buffer, I guess. Right, and then we have community-based pricing for most types of risk. And that's helped through by the fact that we have the NHC, and I mentioned that before. We have flat rates for NHC insurance for earthquakes and some other hazards. Right, so do we need to intervene in New Zealand's insurance market, and can we justify it? This is quite a complicated, not very straightforward kind of question. The report works through it in some detail, and I really encourage you to have a little look at what it says in there. We've talked about the importance of insurance for resilience a little bit already. One of the things particularly that, climate change obviously threatens our fiscal sustainability as a country. So insurance is a way to pass the risk from individuals to the private market. And that can help the state bounce back after a big disaster and makes us more resilient as a country. So I think insurance is incredibly important, and keeping high levels of coverage is incredibly important. There are risks, though, to intervening in a private market. So moral hazard is often brought up. Moral hazard basically means that if you're protected from the consequences of a risk, then you have a lack of incentive to guard against it. So the idea is really that if you don't charge people full whack under risk-based pricing for their insurance, then they won't take the necessary precautions to reduce their risks. So price signals that reflect risk result in more efficient outcomes is the argument. I think the problem with that idea is often that it's not in a person's control to reduce their own risk, perhaps because, for example, maybe only the council can reduce risk for you because they need to build a big flood wall that is obviously not in your power to do as an individual. Or perhaps you could raise your house by a metre, but it's actually just not possible for you financially to do that. So I think we should probably guard against moral hazard, but we should also not give it too much importance. I think the importance of it can be overstated a little bit when it comes to the individual householder and what they're actually able to achieve themselves. I think often if we have risk-based pricing, prices go up, that's supposed to send a signal to the householder to do risk mitigation, but often it will just send a signal to them that they should drop their insurance entirely, which can have negative outcomes for all of us as a country. And then the fairness question, another really gnarly one, which I encourage you to engage with. It's such an interesting topic. What is fair in this situation? Some people might not be happy to help subsidise someone who has, for example, built $1 million home on the beach, who's now upset that it's falling into the sea. Is that fair to help subsidise them? I think the question here is really how much people can be held responsible or not for their decisions and for their own bad fortune. It's quite easy, I think, to blame homeowners for their own misfortunes, but often the picture's not that clear cut. So someone may have bought their house 30 years ago, for example, and not known about climate change at that point. Or they may have known about climate change, but not really understood what that would mean for them. Others may have bought an at-risk property because it was the only thing they could afford at that time. And so I think we'll see that a lot, people buying houses that are at risk because the prices are lower. So my personal feeling, I guess, on this one is that although all of us are a little bit to blame for climate change, none of us is actually individually responsible. And I think it's important that we share the burdens of climate change as equitably as we possibly can. If not, we kind of run the risk of creating, not to be too dramatic about it, a sort of a subclass of climate change refugees, really, a little bit like they're seeing in Florida at the moment, where there are a lot of people who can't afford insurance, whose houses are being repeatedly flooded, but who cannot move on because their houses, all their wealth was in their house, and their house is now not worth anything at all. Let's see what the time is. I am running over time as usual. I just find this topic so fascinating. How can we keep premiums affordable and accessible for longer? Well, I think one of the first things we need to be doing is setting up a really clear climate adaptation framework and funding that appropriately. There are things we must absolutely stop doing, which is building in inappropriate areas and inappropriate ways. We should be investing in a big way in flood mitigation in the areas that need it and where it's cost effective to do so. We should be making homes more resilient where we can, and we should be also putting in place proactive, consistent, fair frameworks for how some properties will need to relocate under a process of managed retreat or planned relocation. So funding that process as well will be essential. If we don't do those things, our prices are going to go through the roof much, much faster. If we do, then we've got a chance to have a bit of breathing room and sort of move towards the future in a more sedate way. So as I mentioned, we can expect an increasing number of insurance gaps to arise over time. Some people won't be able to afford insurance, others won't be able to get it for whatever reason because insurance companies won't want to pay for uneconomically viable properties. So when a specific peril is or is likely to become uninsurable, a government can decide to form a protection gap entity, which is essentially a not-for-profit entity brought about through government legislation, which can provide insurance protection to fill the gap, the expected gap. Now, we already have, obviously, such an entity, the NHC, which functions very well, but doesn't at the moment cover flood risk, except in a very small way for land risk. So if we were to decide to set up a public insurance scheme for flooding, we could look to expand the NHC to take on flood risks as well, or we could look to set up a whole new entity. there's myriads of different ways that we could look to set up a public insurance scheme, and the report doesn't settle on one or another, simply because there's so much more policy work and thinking that would need to be done to decide on the best outcome. But we can look to other countries to see what they've done, and many of those are covered in the report as well. Basically, there's a spectrum. You can intervene a little bit. You could get private insurers to do something like what they've done in the UK with Flood Re. Private insurers have banded together under government mandate to insure just those properties that are most at risk of flooding. Or you could go all the way to what they've done in Spain or France, which is where all flood risks are covered by a public insurance scheme. So there's lots of different ways we can do it. I think that conversation needs to be had very soon as to what we're actually going to prioritise in New Zealand. The French flood insurance framework was one I wanted to point out just very quickly. What I really like about the French flood insurance framework is it's triple-pronged. It has insurance, it has reinsurance, and it has risk mitigation built into the scheme. So there's community-based pricing for everyone for flood risks. But in order to make sure that people don't keep staying and living in houses that are repeatedly flooding over and over and costing everyone an awful lot of money, they have a risk mitigation scheme, which is funded by a premium on your by a levy, sorry, on your premium. Sorry to rush through this, but I'm just going to jump to the last slide, which is the key recommendations. So there's several dozen recommendations in the report, and this is just the top level 4 of them. I'll just quickly rush through these just to sort of give you a sense of what's in the report. Firstly, we've talked about the importance of maintaining high levels of insurance for flood risk, particularly in the face of climate change. So under that recommendation, we think we should establish an expert advisory group to explore how that can be best achieved. And part of that should be to come up with a definition of what constitutes affordability in insurance. You know, we have a proud history, I guess, of helping people who are struggling to afford important public services in New Zealand. Should we be helping people who are unable to afford insurance in the same way? Is the question there. The second recommendation is about investing in physical things to keep insurance premiums affordable and accessible. That means things such as avoiding further inappropriate developments in risk-prone areas, which we just talked about. To do that, I think we need to give councils greater powers to turn down land use consents, for example. We should also be investing in proactive flood risk mitigation and so on and so forth. So in order to do that, we really need legislation. We need some kind of Climate Change Adaptation Act, which sets out who should make decisions about adaptation, when they should make them, what are the risk thresholds that we need to act on, and most importantly, who's going to fund it all. If we don't fund it adequately, we're going to have inequitable outcomes, because some areas are going to have good flood mitigation and some are not, because they won't be able to afford it, which is going to end up costing us all more in the long run. Thirdly, we need to consider a range of really specific interventions in the market. I think we should be thinking seriously about subsidising some people to make sure they don't give up on their insurance. I think we should also be looking at things like thinking about whether insurance contracts should be standardised and simplified so people know what they're insured for and what they're not insured for. I think we should be monitoring insurer conduct and value for money in policies. And I think importantly, we should also be agreeing on the level of transparency that insurers must demonstrate in how they make decisions about pricing. I think increasingly with risk-based pricing, there's the risk that insurers will be making decisions on information that we're not privy to, and we should have some kind of recourse about that. Finally, we talked about the idea of a public insurance scheme. Not straightforward to do that, because flooding is fairly common, fairly predictable compared to earthquakes, and it is going to get worse over time, so it runs the risk of being quite expensive. So again, we need to make sure we've got a really clear climate adaptation framework in place to make sure that that scheme does not become too expensive. I'm thinking of an example I read in the United States where a house under the National Flood Insurance Protection Scheme has been rebuilt 32 times after flooding. I think it was within a period of 34 years. We do not want to see that here. We want to see a scheme that is actually sensible and sustainable for the long term under climate change.